If a practice is incorporated and 100% is sold at one time, does the seller keep his corporation?
Yes, the seller would keep his corporation in a 100% sale. It's called an asset sale because the corporation is just selling its assets. The rest of the transaction involves the seller individually. The corporate assets are both tangible and intangible. Tangible assets would include the dental equipment, office equipment and furniture, dental supplies and instruments, office supplies, accounts receivable. The intangible assets would be charts and records. The corporate assets are going to amount to about 10% of the total sales allocation. The 90% is going to be split equally between personal goodwill and a consulting agreement. This is done to equalize the tax advantages and disadvantages to the buyer and seller. Goodwill, you'll remember, is taxed to the seller at 15%, whereas the buyer has to amortize that over 15 years. The consulting is taxed to the seller as ordinary income, but the buyer can deduct it as paid, so you have a conflict. The assets, on the other hand, are taxed to the corporation as ordinary income to the extent they exceed the depreciated book value. The consulting agreement, here's the good thing. The consulting agreement can be made with the seller's corporation. Therefore, all the payments go to the seller's corporation. The seller can still deduct business expenses through that corporation, therefore reducing the income before any W-2 income is reported. So they get a real good tax advantage doing that. So the seller may elect to finance part of the sale through his corporation through a consulting agreement. So we'll keep that in mind.